Have you been trying to get your finances in order and start investing to create wealth but don't know what you're doing? Well, that's about to change. A new type of show, introducing the Dollar by Dollar Show. Welcome to the Dollar by Dollar Show, where we help everyday people become millionaires by helping them to live below their means and invest early and as often as possible. I'm your host, Andrew Mitchell. Today we're answering the question of should you invest in multiple different index funds or just pick one? So why would we do that? The reason this question was asked was that the person wanted to diversify into another index fund that had bonds. So makes it more balanced and conservative overall investment mix. Let's not overthink it. There are a lot more options today than there were 20 or 30 years ago. So with these options comes a lot of confusion and lack of understanding of what people should be doing. There are index funds that are more aggressive and there are index funds that are more conservative. So for example, you can actually buy an index target retirement fund. That fund is buying a bunch of different indexes, which includes some. So you're probably thinking, Andrew, did you just say I can invest in a fund that tracks more than one index? Absolutely, I said that. There are many examples. So for example, Vanguard has retirement funds that have 5 or so different index funds as their underlying allocations. This helps them become more conservative investment approaches. So if you are more conservative and want to look at diversifying into other index funds to include conservative government bonds, for example, rather than having too many moving parts and lots of different index fund investments, find one. So you can buy just one fund with your contribution. And if that fund is a target retirement fund, like I mentioned, within that fund, you're getting a bunch of different indexes. So you're getting the same diversification benefit, the same auto allocation benefit without having to go pick individual ones. But it comes down to 2 questions. How much can you invest, firstly? And how often can you invest? So that's the first question, 2 parts, sorry. So how much can you invest and how often can you invest? And the second question is, when do you need the money? That's important. The longer you have to invest, the more your returns can strive for. If you look at funds like Vanguard, Fidelity, they're some of the largest and most reputable funds around. These funds will basically do everything for you. They do all the hard work. They ensure they're super low cost, super tax effective. And you don't have to worry about all these things that take a lot of time and specialty to sort out and manage. They're passively managed funds, not an actively managed fund account where you've got high fees. Okay, so these companies make it so simple for you that you can actually select a retirement fund that fits your timeline until retirement. So for example, I'm born in 1986. If I wanted to invest in a Vanguard Retirement Investment Index, I could invest in one that has a Vanguard Target Retirement 2050 fund that fits the 1986 birth year. To give you an idea of exactly the breakdown of this specific fund, it holds 5 different index funds. Yes, that one investment, I hold 5 type of balanced approach for the investment time frame. Again, this one may not suit me. I don't invest in this one specifically because I like a higher risk, higher reward, which I'll go through shortly. But this one specifically holds 5, and I'll go through them. So 54.1% hold Vanguard Total Stock Market Index Fund Investor, Vanguard Total Stock Market Index Fund Investor Shares. 36.3% hold the Vanguard Total International Stock Index Fund Investor Shares. 6.6% Vanguard Total Bond Market 2 Index Fund Shares. 2.9% Vanguard Total International Bond Index Fund Shares. And Vanguard International Bond 2 Index Funds. So you can see the majority is held in shares. You've got 2 different types, and if you've got 54 and 36, you've got over a fairly big chunk, 90%. And the reason that it's still classified as a higher return fund is that it's still got 30 plus years, or give or take 30 years until the use of funds. So again, you can select a whole different range of retirement funds. Okay. However, if you compare this one to my favorite Vanguard fund, the Vanguard S&P 500 Index Fund ETF, this report per year across the last decade, And the Vanguard S&P 500 Index Fund ETF has returned over 14.5% per year. So we're talking 44% more across the same time frame, which is huge. But again, the same time frame, which is huge. But again, if you look at the two, one is slightly lower risk, the other slightly higher. So if you can find something for your risk tolerance and also your investment time frame, that's the best. So if you're looking actually for the best performing index funds, I'll give you my top 3 recommendations. I do want to be clear. Nothing constitutes personal advice. This is just based on fact, historical performance to predict future performance. So it's all general advice and what I recommend and what my opinion states. One thing that you'll also notice with these 3 top picks is that they all have very, very low expense ratios. This is important. Expense ratio of, let's say, 0.03%. So it's classified as the amount that you pay per $10,000. So a 0.03% expense ratio means that for every $10,000 that you have in that fund, you will pay $3 in fees. I'll go through this quickly. The reason it's important, even just a small increase in the expense ratio can cost you a lot of money over time. So in no particular order, the top 3 funds, index funds for capital growth in your fund itself. So the Schwab US Large Cap ETF. Schwab US Large Cap ETF. They have an expense ratio of 0.03%. So for every 10,000 invested, you pay $3. The average yearly return over the last decade for this fund has been 13.55% year on year. A common question, though, that gets asked, what do they mean when they call it US Large Cap ETF? So basically, this is a fund that tracks the Dow Jones. It consists of over 750 of the largest US companies. It has holding companies in industrial sectors, in IT, healthcare, consumer discretionary, what else? Communication services and finance. So some of the ones that you'll be investing in, if you invest in this fund, will be Apple, Microsoft, Facebook, Tesla, banking, you got JP Morgan. And they also pay a dividend. It does fluctuate, but it averages around 1.5%. Look, what's really powerful when you're looking at these funds, if you reinvested that dividend, you're getting another 1.5% on top of your 13.5%. So total, with this fund, over the last decade, if you invested, you'd be getting 15.05% per year on year. Now that's massive. It's unrealistic. Well, I've just shown you that 10% is damn realistic. It's not only realistic, it's been proven. 15.05%. Second on the list. So we've got an index fund that's tracking the Dow Jones. Second one on the list is an iShares Core S&P 500 ETF. Okay, so now you're thinking, what's it tracking? It's an iShares fund. It's tracking the S&P 500 index, and it's traded as an ETF. Okay, it's traded through the brokerage exchange. It's an expense ratio of 0.03%. Very low expense ratio, which is good. First tick. It also consists of more than 500 of the leading companies in the US. And like I mentioned, it's designed to mimic the S&P index. So this index, it has companies. So if you invest in this fund, you'll be investing in sectors such as IT, healthcare, consumer staples. And off the top of my head, some of the companies that you invest in are like Home Depot, Procter and Gamble, and Visa. So this fund, look, the good thing about this fund as well, it's highly traded a day. And they also, again, they pay a dividend. That's very good. 1.8%. So again, over the last decade with this iShares Core S&P 500 ETF, if you reinvested your 1.8% approximate dividend, and you added that to your 13.83% year-on-year growth that you've received, you'd have 15.63% return year-on-year, higher than the first one. And lastly, I could not leave this one off, the ETF. You'll hear me say this one all the time. Again, it's an S&P 500 tracking index, so similar to the iShares Core S&P 500 ETF. It has companies in the fund like MasterCard, Amazon, Home Depot, and United Health Group. Expense ratio is the same as the others, 0.03%, and a high liquidity again with, I think, just under 1 million shares a day trading. So this one, over the last decade, this fund has performed 14.45% year on year. Its dividend yield 1.45%. Did the dividend, you would have had 15.9% year on year growth. So if you're talking to anyone and if they have told you that they're getting 15.9% per year, you'd be going, wow, what are you doing? And then if they could evidence that 15.9%, nearly 15.9%, nearly 16% year on year over a decade, I don't know why this fund's not getting more recognition. It's a popular fund, but a lot of people do not realize the power of index funds and how much money you can actually make by just being consistent. By even if you stuck $500 a month into an index fund, returning 16% a year on year, you'd be a millionaire well before retirement. Look, earlier we were speaking about having even more diversified, and I'll raise it again because diversified, we're really just calling a more conservative. I invest in more. If you're looking for a fund that holds some more conservative assets, you might want to consider looking at a targeted retirement fund. So the answer is no, don't invest in more. Have a look at your goals. Find out how long you want to hold it for, when you're going to need the money, because that will then help dictate the type of investment that you want. To make and the conservativeness and all those sorts of things. So earlier I gave you an example of a Vanguard fund. That was just one of the funds. That was a 30-year till retirement fund. So it still held 90% in higher growth assets, and it held some bonds and those sorts of things. Look, you can conservative. Again, more conservative means less return. So let's not just go and have a look at the most conservative because we're worried about obviously losing money. History shows us over the last 100 years, you would not have lost money in the market. Yes, 1 year you might have lost money, or 2, or whatever it may be, but you will make it back. An example is that Vanguard S&P 500 ETF. If you invested 1 year, and I think, I can't remember what year it was. I think it might have been, 2018. It went down by nearly 5%. So if you invested $100,000 at the start of 2018 and you took your money out at the end of 2018, you'd only have $95,000 left. Oh, that's not a good investment. Well, that's the whole point. You shouldn't have touched your money. Because the next year it went up by 21%, 11%, then it went up by 1%, but then it hit 13, 32, 15, and then dropped back. It's volatile when you look at short term. It's stable over the long term. So don't get scared. If you're fearful and you're going to check it every day, it's pointless. Just know that investing consistently in the right index fund over a long term is going to make money. Like we mentioned, there's more conservative funds going to make money. They're going to hold more bonds and inflation-protected assets, not inflated. The prices aren't inflated. So they hold bonds and inflation protection. So if you're going to think of it, okay, well, what are they? It's more about capital, but it's more about capital protection, okay? Because at the end of the day, if you just stuck that in an account and let's just say you got no interest. Let's just say it was a no interest account. Inflation is going to devalue your money. So the idea with the shorter term frame, more conservative, more balanced funds are more about ensuring that they beat inflation and then a couple of percent or a few percent more, so that you've got your capital protection. So if you've got it in a capital protection fund, it might get 6%, whatever it may be. So you can comfortably take out 4% and you get your couple of percent inflation. So you for the rest of your life as an income. But again, this is more for conservative, diversified portfolios. So to answer the question, I think I might have answered it if you're following along. Should you invest in more than one index fund? No, you absolutely should not. Just ask yourself the two questions I posed earlier. How much can you invest and how often? When do you need the money by? Duration of time until retirement, the amount of money to be invested, and its frequency of investment will help you determine the type of fund that you should be investing in. I really hope that this has helped you understanding index funds and more. Rather than juggling too many investments, you can find one that meets your needs. And again, I can't recommend Vanguard enough. They've got funds that meet every need that you might want. It's a passive investment, meet every need that you might want. It's a passive investment. They've got more active investments and everything in there, but you look at the passive investments, find one that suits your needs. And I've just rattled off 3 of the highest performing index funds in the world. And with your Vanguard, your Schwab, and your iShares, one tracks the Dow of a Vanguard retirement fund that fits my birth year. Again, find your own birth year. Have a look at the asset classes. They're there. They're transparent. And then you can have a look at different types of Vanguard retirement index funds if you want to have bonds in your portfolio. If you've got more than 15 years to retirement, I do not. If you've got more than 15 years to retirement, I do not see the need. You want growth. Over 15 years, that's a long time. If you want 6% a year, and that's obviously one of the close retirement ones for the Vanguard, or 15.9%, you need to ask yourself those two questions and have a look at the Vanguards, iShares, and your Schwabs. Look, 3 of the highest performing funds, and the good thing about it is they have a large management of funds. Sorry, large portion of funds under management. So thanks for listening today. Look, subscribe to our podcast. Jump on to dollarbydollarshow.com. Join our mailing list. We've got lots of educational stuff coming out. And look, good thing about it is all our information that we provide is free of charge. We're just trying to help everyday people become millionaires. Live to the motto. Live below your means and invest early and as often as possible. Wishing you a good day and fat wallets.